All right. The reason why I'm laughing at the introduction of the show itself is because my guest on the show is someone who's always happy, always blissful, always laughing. And some of the stocks, if I tell you where he's invested in, well, they'll make all of us smile, because if you followed that advice over the years on buying good businesses, holding them, ignoring P multiples, to use them as the only yardstick to judge the true value of the business, well, trust me, you would have had a good run when it comes to investing in stocks like Trent, Indian hotels, and even for that matter, names like Titan. So it gives me great pleasure to bring on board Mr. Milind Karmarkar to talk about markets, themes, ideas, and where is he picking up spots in this market. So I guess the introduction was a fair summary of your philosophy of life.
Yeah,
keep smiling, keep going.
Yeah, absolutely.
Bull markets, when Trent was at 100 rupees, you were smiling. Trent at 3,000, you're still smiling.
Yeah.
That's the philosophy of life.
That's the philosophy, absolutely.
So, for our viewers to smile and for them to laugh now, they perhaps need insights from you about markets, about valuations, and about how should you approach the market now. We are at that juncture where India is now a discovered story. We are at that juncture now where sliver of the market offers value. We are at the market now where 80% of the investors in the last 2 years, they've made double-digit returns.
Correct.
How would you map the risk-reward ratio for next 2 to 3 years for genuine long-term investors?
Okay. So, frankly, I thought you will ask this question. So I was doing some math.
I'm not getting very predictable about it.
No. So I was doing some math, and over a very long period of time, markets have returned about 1.6 to 1.7 times the GDP growth.
Okay.
2018 to 2023, I think the GDP has grown roughly by about 60%.
Okay.
And the markets have grown by 100%.
Okay.
So yes, there is a slight, you can say, move ahead of times. But if you think that Indian economy will grow at the rate what everyone is talking about, which is 6.5–7% real GDP growth and about, say, 5–6% inflation, then we will have about 12% inherent growth in the economy itself. And that probably will drive the markets anywhere between 18 to 20% in the next year on year for the next 20 years. So next 5 years. So there is possibility that sometime it may stagnate. But overall, I wouldn't be surprised if the markets at least go up 2.5 times in the next 5 years.
2.5 times in the next 5
years.
Okay. And you're talking about the index level here?
I don't know the index level, but it will be, that is what will, because that's just a number. So I am looking at, so if the index doubles, frankly, the market should go up 3 times. But I'm just giving it a bit of a discount, and I'm saying 2.5 times.
Okay, so are you saying then, I don't want to get this one wrong, because that clearly is the most bullish voice for us so far this year. We are a $4 trillion economy.
Yes.
If you feel that markets will go up to 2.5 times the next 5 years, are you making a case that the wealth of the stock market could be anywhere between $8 to $10 trillion in 5 years?
Yes.
Okay. Now, if the market cap of Indian stock market has to go from $4 trillion, I'm still counting numbers, $4 trillion to $8 to $10 trillion, what will drive it higher?
So I think, because what happens is that when economy grows, everything grows. But I still believe that it will be consumption. I mean, I'm coming back to my theme, because that's a theme where India has got a very long-term growth pathway. But again, just would like to reiterate that when I'm talking of consumption, it includes finance, it includes pharma, it includes FMCG, it includes retail, it includes hospitals. So all of these would participate and grow significantly, because it's very simple. What we are consuming today, maybe 6–7 years down the line, rather what the GDP is today, 6–7 years down the line, we will be consuming that much. So that is the kind of opportunity which, and more, because people will leverage and things like that. So that is the reason why I think that it will be predominantly be driven by consumption, but within consumption, as I said, there are different sectors. So each of these segments could, like, frankly, if you see, banks have not moved at all. So I think banks could drive the index over in the shorter period of time for at least 1 or 2 years. So I think long-term consumption will continue to be the theme.
Okay. Now, if at $4 trillion, the stack is that you got Reliance right at the top in terms of a market cap.
Yeah.
Then you've got HDFC Bank
Correct.
and HDFC put together right top there. So if I look at the stack in India, we don't have a single $500 billion company.
Correct.
We have only one or two companies which have a market cap which is north of $250 billion.
Yeah.
So if you have to go from 4 trillion to 8 trillion, what could be the pecking order in terms of the large companies and how large they could become? Do you think India could get a $1 trillion company in the next 4 or 5 years?
So I wouldn't speculate on which company could deliver that, but it will definitely be in a banking space. Okay. That is what I think will happen.
Okay. Do you think that if the economy has to go, the stock market wealth has to grow again from 4 trillion to 8 trillion, it could be driven by new companies, new themes and new sectors, because there has to be some wealth creation of $500 billion, 500 billion to a trillion which has to happen, which today we cannot foresee.
No, it's possible. So it's like this, that so if we divide the market into two parts, there will be this entire market which will grow 1.5, 2 times. And at the same time, there will be some of the companies which can drive, which can go much further. So okay. Yes, that is possible, but that would, in all probability, would be in mid caps.
Okay. Let's look at the real outperforming sector of last 12 to 18 months. You add a prefix PSU, add a suffix India or PSU, those stocks have done rather well.
Yeah.
2020, they were the ugly ducklings. Nobody wanted to buy PSU
Yes.
stocks with a barge pole. They are now the darlings of the market. Do you think this is just mean reversion, or the way companies in the government stable were doing business versus the way they will do business? Markets are excited about it and the markets are just voting for rate of change.
So I think that they will do far better than what they have done earlier. If you take a 15, 20 years view. But whether they, in terms of market cap or in terms of price, whether they will give the kind of return in the last 2 years, that I have my doubt.
Where is value in this market according to you?
Sorry?
Where is value in this market?
Value is in banks. There's no two ways about it. Definitely value is in banks.
Okay. When you say there is value in the banks, some would also argue back and say that, look, interest rates have peaked out. Cost of liability or the war of liability continues, and there is a disruption coming from the fintech space.
Yeah.
When banks were earlier making money by transaction, now UPI has taken over. Fee-based income is actually getting challenged because of fintech and buy now, pay later kind of a model. So optically, banks are the best play on economic growth. But do you think somewhere the earnings could also get jammed largely because of disruption and the new RBI guidelines?
So yes, in the shorter term, maybe there could be some kind of a slowdown, though I don't believe that will happen. Because if you're banking on a rising per capita income, say from $2,500 to maybe $6,000 in the next 8 years, in that case, I think the demand from retail on banking side also will be huge, even for mortgage loans, or even for, not only clean loans, but also for mortgage loans and a lot of other things. So I don't see any reason why banks should slow down, because simultaneously we are also seeing industrials, the new capex cycle starting. And that will also drive growth. However, I don't think that there will be a significant demand from industries for large loans in banks, because if the markets are vibrant, maybe they will come to the market. But yes, it will definitely help, because banks have a solid balance sheet, so have the corporates. And because of that, I think there will be a demand from the corporate side as well. But it will be ultimately retail which will drive.
If I take the clock back 5 years ago, there were two banks which were top of the pedestal, HDFC Bank and Kotak Bank.
Yes.
The Indian banking sector was in a mess. PSU banks were getting recapitalized. Yeah. Large banks like ICICI Bank and Axis Bank, they had their own issues of leadership. So two banks, they held out and they commanded disproportionate amount of premium.
Correct.
That novelty has faded away.
Yeah.
So do you think now we should look at banking sector in the same breath and we should not differentiate between PSU and private?
I would still give more weightage to private sector banks.
Why is that?
When it comes to retail lending, the PSU banks have still not got their act right, and it will be some more time before they get their act right. And that is the reason why I think private sector banks will probably be better off as compared to the public sector banks.
Who has the right to win then? Will the large private banks become bigger? or the small private banks will also catch up within private, who has
So
the right to win?
I think it will be across the board, but the larger ones will have a better reach, so they will definitely become bigger.
When you look at a stock like HDFC Bank, they've done all the right things.
Yeah.
Merger has gone through, cost of liabilities coming
Correct.
under pressure.
Correct.
At that large base, they're compounding in mid-teens. They're getting more than 20% market share of the fresh CASA which is getting generated. Everything is going right for them. But nothing is going right for shareholders. Stock chalta hi nahi.
So sometimes it also happens that a stock stagnates. I remember even Trent between 2013 and 2017 didn't go anywhere. But that doesn't mean that the business was bad. Business was good. But probably it had run ahead of times, or probably people were not willing to buy stocks at a higher P. But things change. And I think that the same thing will happen in banks as well, including HDFC Bank.
The fact that Trend has been an outlier for you, and a lot of our viewers must have benefited from that by simply following your advice. I just want to understand your thought process there, because you bought Trent, I think, 20 years ago.
Yes.
Irrespective of the twists and the turns of the economy,
Yes.
you decided not to sell Trent. You
Correct.
did not sell when there was TMT bubble. You did not sell when there was 2008 crisis. You did not sell when there was taper tantrum.
Absolutely.
Trent was never cheap as a stock.
No.
It was always 40, 50 times, even in the worst of the times. But what gave you conviction, A, not to sell? B, what gave you conviction not to sell even when it was not growing? Because there were some lean patches for Trent.
They were. So I used to keep meeting Trent. Again, the idea was not to get any insider information. But
Routine.
the basic thought was that the logic by which we had invested continued to hold. So their focus was very clear that they will grow only when they have got their business model right. And their focus was very clear that offer value to the customer and the customer will come in. Like, I'll give you an example. Like, way back in, say, 2002-3, when Trent was only three stores. And if you would go to a West Side store, in all probability, you would get a shirt for a 200 rupees.
Are you wearing a Trent
time.
shirt?
Sorry?
Are you wearing a Trent shirt?
No, not today.
Okay.
Not today. Let me clarify.
Okay, you would get the shirt for 199 rupees.
Yeah, at that time.
Okay, this is 2003.
Yeah. Now, that time the India's per capita GDP was about $430.
Yes.
Today we are at about $2,700. If you go to Zudio today, you will still get a shirt, a similar shirt, for 200 rupees. Now the issue there is that, yes, maybe that time it was 100% cotton, this will be cotton plus something. But they have been able to maintain the price point. And that's the beauty, because then they have merchandise for every person who enters the shop. So when India's per capita income has moved up from $430 to $2,700, even then they have a price point for someone who may be at $430. So that is the kind of
They've got the
business
customer
model
and the price point and the supply chain right.
and the supply. So I'm coming to that. So supply chain is the key. Price point is also key. And to grow only when you get your business model right. They have done exactly the same thing they did with West Side, and they are doing the same thing with Zudio, and I think they will do the same thing with Star Bazaar as well.
Okay. We're discussing a thought here, and I have just one more follow-up question on the Indian retail industry. The fact that you decided to invest in Trent was also at a time when Future Group was expanding.
Correct.
Reliance Retail got created.
Yes.
Aditya Birla Fashion moved into this acquisition spree.
Yeah.
You decided not to really move to other corporate giants who had the same promise and the same appeal.
Correct.
What gave you the option not to bet on Future Retail or Aditya Birla Fashion or Reliance Retail?
One, of course, was that Trent was betting on private labels, and I knew that private labels have done well globally. That was the first thing. Second was that they had decided to grow without taking any debt, because retail is one of the toughest businesses and with not as high margins as manufacturing. So you need to have your finances absolutely tightly controlled, and that's what they did, and that was the reason why I decided to invest in Trent and not in other companies. Reliance, again, retail, the issue was that it was sitting in another listed company where predominantly it was petroleum.
Okay.
So when I was looking at retail, it was only two, Trent and Titan, which we decided to invest in.
The lovely book, I'm sure you've also read it, book from Pulak Prasad,
Yeah.
on what to do, what not to do. Be extremely lazy, not just lazy, be extremely lazy. Is that your
Absolutely.
investment philosophy, that just be lazy, not just lazy, but extremely lazy? Buy a stock, just don't worry about it after that.
So I would put it, especially for a retail investor, I would say that yes, you need to be lazy definitely, but at the same time you also need to keep, I mean, returning back to your investment thought and just confirm that the investment thought continues to hold in the company. As long as that is there, you don't need to do anything if the prices move up and down. No, not at all.
Between 2022 and 2024, it's been 2 years now, have your top 5 holdings changed?
Uh, Not really.
Okay, why is that? Because markets are
They
up 50,
continue to do well.
70%.
They continue to do well. Trend. So it's like this.
What are your top holdings then, just for disclosure purposes?
Trend, ICICI Bank, Titan, and Syngene. Four I remember. The fifth one I don't remember.
Okay, so top 4 holdings was same in 2022?
Yes.
Okay. I'm not getting into a stock specific conversation, but when you look at a company like Titan, when you invested in Titan, it was a watch company.
Yeah.
Now it is a jewelry company and they're migrating into other businesses. What do you think they've got it right? Because again, the jewelry business in India is highly competitive.
It is highly competitive. But again, so we entered into Titan at that point in time because it had gone into jewelry.
Okay.
So that was one of the main reasons. The second was that, of course, their focus was trust. So they started those machines where you could go and test the purity of gold. Because ultimately buying gold is all about trust. So people buy from a neighborhood jeweler because there is trust. So that is the reason why they could attract a lot of people to their stores. And I think that's what was the main winning factor. And of course, then comes the brand and then comes the designs.
So when stocks they grow at what could be called as P multiples which are above averages. For example, Trent now is trading at a P multiple of 100 plus. Titan must be 40, 50 times 1 year forward depending on the estimate you look at. You don't get the temptation of switching, selling, buying something which is cheap.
So as long as I don't see any business which can grow faster than them, that is one. And frankly, when it comes to Trent, the P multiple, I think one needs to go through the balance sheet. One needs to analyze that because of Ind AS, the changes which have come in, when future liabilities you have to adjust by amortization and interest. So if you adjust for that, it may not be at such a high P. It will still be at a high P, but not as much as 100 plus. So that is one. And second is that as long as they are growing at 40-45%, I don't think there is any problem, because at that rate, the P multiple can collapse if the price remains same, which it doesn't, because if they continue to grow, the price also goes up.
Why do you think Indian pharma sector has a lot of scope for re-rating?
So yes, I think that in future it will be Indian pharma sector which is likely to do very well, because as I think I have said that earlier also, that long back I had met Dr. Reddy of Reddy's laboratory and I had asked him, because that time their focus was exports. I said, why not India? So he said that unless and until India's per capita income grows significantly, where people can start affording medicines, India will be a slow growing business for them. And that's the reason why they are focusing on exports. But now I think things are changing. Our per capita income has gone up. And because of that, I think companies which are focusing on India also should do very well. And that's the reason why I think that overall Indian pharma would be a sector which can be worth looking at.
So should one then look at MNC pharma companies also, because they are a pure bet on India? Because for all other companies, whether they have, whether it is Cipla or Dr. Reddy or for that matter Sun, either they have presence in Europe or in US or in both, and the third one is Africa. So how does one differentiate if one has to bet on the Indian pharma per capita growth?
So I agree with you that companies which are focused predominantly on India should be on your radar. You should look at them. Look at the products in which they are in, because that is very crucial. Ultimately, it's diabetes, cardiovascular. These will be the sort of segments which will do very well in India as the per capita income goes up. So anti-infectives will also do well, but predominantly it will be diabetes and cardiovascular, which should do well. So look at those companies and invest in them.
When we spoke last time, you said you were bullish on manufacturing, and you said you
Yes.
bought into railways.
Yes.
You bought into EMS.
Sorry?
You bought into electronic manufacturing as a sector.
That's correct.
Are you still betting on EMS?
So EMS is one portion of our overall investment. We are invested in some other companies also, but predominantly we are looking at those companies which can benefit out of gases, which can benefit out of power sector, and which can benefit out of railways besides EMS.
Do you think the manufacturing sector in India will grow faster, or the consumer sector in India will grow faster?
I think if you are taking a 10-year view, in all probability, consumer sector will far surpass the manufacturing sector. But in the shorter term, it's possible that manufacturing sector will grow faster.
You've been holding on to insurance for a while now, and that is one space where a lot is changing.
Yeah.
I understand the big picture in terms of, okay, Indians will need better healthcare. We can afford better healthcare that will take care of your health insurance. We value safety of our life after COVID, which means we will also see more and more, migration happening towards term insurance, which is also taking care of your near and dear ones. But the Indian insurance sector, Mr. Karmarkar, is going through a tough time. New entrants, consolidation, LIC suddenly, waking up and taking giant steps forward. What is your view on insurance, which for our normal viewers is a complicated sector to understand?
I agree, it's a complicated sector, but you will have to take a bet which is based on what kind of growth can insurance companies deliver over a longer period of time. Because ultimately, it's all about affordability. So if ultimately you have to afford hospitalization, you have to afford medicines, then you need an insurance. And that is where I think the growth in insurance will come in. Yes, we are holding it for a pretty long period of time, and they have been underperformers in our stock, in our portfolio. But we'll continue to hold because our thought process is simple, that if there is growth in this sector, we'll continue to hold it.
You like consumption, but you've not used the word luxury consumption. Why is that?
I think the per capita income needs to grow up further. If it grows, we'll definitely look at luxury consumption. I mean, we are indirectly holding, so we are holding Trent, so we are indirectly get benefited out of Zara. But Zara in India is a luxury consumption, not globally. Globally, it's a mid-level fashion kind of thing. But yes, that's what per capita income growth will happen. Once per capita income growth goes up, then probably we'll look at luxury consumption also.
They say that when consumption per capita reaches $3,500 to $4,000 per person or per capita, you could see a binge uptick in consumer spending.
Yes.
So where do you think excesses in the consumption space will get created?
I think it will still be apparel. Okay. Apparel and probably ancillaries. So, but apparels predominantly. It's very easy to buy an apparel.
Have you resisted your temptation not to buy into any of the consumer tech and fintech stocks?
So we have bought one into food tech recently,
okay, but
not consumer tech and neither fintech, because we are still looking at them, and we think that banks are equally good fintechs. So we are, and of course there are a couple of NBFCs who are using fintech quite a bit. So we are invested in that.
What prompted you to change your heart to buy this food tech company?
Positive cash flows, at least to begin with. That's what I had said earlier, that if they show me a positive cash flow in one quarter, I'll buy.
But is that a basic criteria for you to buy? You will only buy companies if they have a positive cash flow?
Yes.
Let's talk about IT, and this is where I think the jury is still divided.
Yeah.
Old timers would say, look, Indian IT companies have migrated the curve of Y2K. They came as real winners when the enterprise platform adoption happened. They were the outliers in terms of gaining market share and maintaining the relevance when smack and digital also was at play. Yeah. That's the naysayer who's saying that don't worry about AI.
Correct.
The new theory is that AI is actually not just a wave. It is the way how the sector now would be, in a sense, doing business.
Absolutely.
What is your thought? Do you think this is like a temporary disruption, or the Indian IT sector now, the foundation has got shaken?
My view is that they will need to adapt to AI.
Can they do that?
They will, sorry?
Can they do that?
I don't know. Jury is still out. So I really don't know. But that's the reason why we are cautious on IT. We will continue to be cautious and take it one at a time.
I don't see too many bets, at least in whatever information in the public domain is available when it comes to EVs, or for that matter, energy transition. Aren't you betting on these mega themes?
So yes, we have one gas company in our gas in the sense, one which is not gas in sense gas, but the largest industrial gases company, which is Linde, we have in our portfolio. But besides that, in EVs, we are playing it through Exide, which is there in our portfolio. But besides that, we have not taken anything.
A lot of naysayers, I will not use the word naysayers, but this now seems to be the consensus view that there is a bubble and there is a lot of trouble in small and mid-cap stocks. What are your views for that?
I agree. There is a bubble. It's not a bubble, but yes, there are certain things like old names which I have never heard, which I used to hear maybe in 2002-3, suddenly people calling and saying, what do you think about these companies? That's what worries me. Sometimes there is a word chip in a company and then they say, this company will do very well because it's planning to, get into chip manufacturing. It's not so easy. So I think there are excesses in mid and small caps.
And I remember in 2000, real estate companies had become IT companies.
Yeah.
In 2008, those IT companies had become real estate companies again. And those IT companies are becoming chip companies. Yes, when there was both. And now they're becoming chip companies now.
Yeah.
So manufacturing is the space where everybody is excited, but the reality would be very different.
Absolutely.
I'd like to draw your attention to something which you've always endorsed, which is think long term.
Sorry?
Think long term.
Yeah.
In the near term, markets will always swing because of sentiment.
Yeah.
So if one has to look at the pendulum of the market, where do you think there are excesses in the market? And where do you think there are still opportunity in this market?
I think mid and especially small caps, there are excesses. I won't say they are across. So it may continue for a long time because I've learned that during the software boom that when you think there are excesses, the prices can grow 4 times from there. So I'm not a person who can say that, okay, don't go there. It's individual choice. But as a fund manager or as a person who is managing money in trust, I would not get into that at all.